to today's IGIER policy seminar. The broad theme is low interest rates and their implication for fiscal policy. The participants are, as you might have seen, Olivier Blanchard, Senior Fellow at the Peterson Institute, Emeritus Professor of Economics at MIT and former Chief Economist of the IMF, and John Cochrane, Senior Fellow at the Hoover Institution, formerly Professor of Finance at the University of Chicago, and grumpy economist blogger. The debate will be moderated by Alberto Martin, professor at CREI and the Barcelona Graduate School of Economics. So before we start, let me thank you, Olivier, John, and Alberto for making this exciting event possible. Alberto, please go ahead. The floor is yours.
Thank you, Nicola, very much for the invitation. It's my pleasure, actually, to interact today with Olivier and John and everyone else on this very interesting topic. So the way we will proceed is as follows. We will go straight into the subject matter. We will give both Olivier and John about 20-25 minutes to present their respective points of view. I will then try to start the debate with a few questions. And then we will open the floor to the rest of you. So we will take a few rounds of questions and we'll take it from there. Let me just say that we will open the mic, but if during the presentations you want to send some questions via chat, I can take a look at them and then maybe we can do a mix. We take a couple from the floor and I take some from the chat. Okay, and without further ado, let's go on to the presentations. We'll go in alphabetical order to avoid any polemic. And so I'll let Olivier go first and then John will go second. Olivier, the floor is yours.
Thank you. It's good that B is just before C, right? Let me share my slides and just jump in. I'm looking forward to this. Discussing things with John is always fun. And I'm thinking of writing a short book probably on fiscal policy, and therefore this was a good way of putting my thoughts together. I have 7 slides. I'll try to cover as much as I can. It's going to be a fairly quick journey, but I'll do my best. So the first slide is kind of, I think, the traditional view, and probably the view that many policymakers still have about fiscal policy, about debt, about deficits. And so let me go through steps which will be familiar, I think, to any of you who have been thinking about the issues. And the starting point for any discussion of fiscal policy is the dynamics of the debt to GDP ratio. So little d is the debt to GDP ratio. S is the primary surplus, which is taxes minus spending, excluding interest payments. And then the equation is given by this. If there was no growth, then D would be just 1 plus R times D minus 1 minus S. But if there is growth, the fact that GDP is increasing changes the formula a little bit. And D is equal to this coefficient, which is 1 plus R over 1 plus G times D minus 1 minus S. And the standard assumption in discussions has been that R is greater than G, so the coefficient here is greater than 1, and therefore other things equal, this leads to debt explosion fairly easily. So to avoid debt explosion, and again, that's the extent, I think, of the algebra in that in my allotted time, if you want D to be constant, D to be equal to D minus 1, then you're going to need a primary surplus, which is equal to R minus G divided by 1 plus G, but that's not very important. The important thing is R minus G times D, and given that R minus G is positive, then you're going to need to generate a primary surplus in order to keep that to GDP stable. Now, how does this give you a sense of debt sustainability? Well, I think the idea is that you're going to need to generate a surplus, a primary surplus, and there's probably a limit to what you can do. So given this limit, then this is going to determine the maximum level of debt that you can that you can handle while avoiding a debt explosion, and that's going to give you a limit to the debt ratio that you can afford, right? Now, in this case, basically, that is sustainable if government can generate, sufficiently large surplus, and the higher the debt, the higher the needed surplus, or the higher the surplus, the more debt you can actually afford. And higher debt means higher taxes or lower spending in the future. All this is very much, standard undergrad stuff. It's in my textbook. It's very familiar. The part about welfare, which is important, is that there is a welfare effect of debt, and typically it's negative, because at potential output, assuming you're starting from an economy in which you're already at potential output, then debt will have to crowd out capital accumulation in portfolios. And the result is lower investment, lower capital in the future, lower output, and therefore you basically, the cost of debt is not so much the taxes which will have to be paid in the future, but the decrease in the capital stock, which is crowded out by debt. So in the traditional view, there's a fairly sharp limit to how much debt you can issue. And the more debt you have, the higher the welfare cost. So that's where I think most people were 10, 15 years ago, and where many policymakers still are. Now, currently, and I'll come back to the currently part, which is clearly the central part, is R is much less than G. And so the question is, well, suppose that R remains less than G into the indefinite future. Now, I want to come back to this, and clearly this is not true with probability 1, but assume it is. So think of, let's call this secular stagnation, to be nice to my friend Larry Summers, and let's think about dynamics and welfare under those conditions. So suppose we were in that world forever. Then the dynamic equation is exactly the same one, but now it has a very different form, right? The coefficient in front of d minus 1 is 1 plus r, 1 plus g, as before, but now if r is less than g, this coefficient is less than 1. So that doesn't explode. The coefficient on like that is less than 1, and it tends to converge to something. Now, you can say, well, what do we need in terms of a primary balance to actually stabilize that? So you put d is equal to d minus 1. Same equation as before, but now r minus g is negative, which means that you can actually have constant debt to GDP and run a negative S, a negative primary surplus or a primary deficit. And so just the arithmetic here can be stated in 3 different ways. And I think it's useful to do that. The first one is that you can actually run a primary deficit and keep not debt stable, sorry, but debt to GDP stable, right? So you don't need to actually generate a primary surplus. Clearly, there's more room to have debt because it's easier to have a deficit than a surplus. The second proposition is that no matter what the primary deficit is, so no matter how negative S is, that will not explode because technically it's an AR1 process and it will converge. So it may increase a lot, but it will not explode in the same sense as it did in the previous slide. And then the third one, which, you know, when it's fairly obvious from the arithmetic, but when you state it in words, people and policymakers just react very badly, is that suppose you start from stable debt to GDP and you issue more debt and you never raise taxes. But in this case, what happens is that debt will actually not explode, but it will converge. And you will never have to repay. You will never have to increase taxes. So the debt to GDP ratio will decrease without you ever having to increase taxes. So the notion that that implies higher taxes in the future is just not true. You basically just wait, and time does it for you, because debt is increasing at R, the economy is increasing at G, R is less than G or G is greater than R, and therefore the debt to GDP ratio will decrease. Now, the question that I get in this case as well, how can this be? You issue debt and nobody ever repays it. And the answer is, well, no, it's not future taxpayers because there are not going to be taxes, but it's the current and future investors who are basically accepting voluntarily to lend to the government at a very low R. That's basically where the way the debt is, if you want, repaid. So this is arithmetic, and nobody can disagree with arithmetic, I think. The interesting question, the question that kind of obsessed me for nearly 2 years and led to my AEA lecture on the topic was, what about the welfare cost? I mean, the government can do it. Should it do it if it cares about welfare? And you know, you look at the world, R and G. What is R? Is R the safe rate, or is R the average marginal product of capital, which is clearly higher than G? And so I struggled with this until I realized that, to a first approximation, the low R, the low safe rate, R is the safe rate, is basically the right measure. It's a risk-adjusted marginal product of private capital, because people have a choice between holding capital or stocks, if you want, and holding a safe asset. If they are willing to hold a safe asset for much less in expected value, it must be that this represents the risk that they don't want to take. And so when I worked out the algebra, the conclusion was a bit more complicated, but to a first approximation, it is the case that when R is less than G, there's a good chance that although you're going to have crowding out of capital, you know, that still crowds out capital in portfolios, this is actually going to be good, because in effect, the risk-adjusted rate of return on capital is very low, and you have too much of it. Or to refer to an old discussion, you have an economy which is dynamically inefficient. And therefore, it actually, debt is not only feasible, which was the first half of the slide, but it is actually desirable. So when I wrote the lecture, I thought I could not, with a straight face, say debt is good. And that led me to say, well, there's ambiguity, so debt is not so bad. But actually, if you look at the data, you may come to the conclusion that actually the welfare cost of debt is very small or even negative. There's a benefit to it. So this is clearly a completely different world in which you can issue debt, you don't have to repay it. It's actually good for the economy. And this, you know, if R less than G was going to be true forever, then this would have very dramatic implications. And so I went through this slide just to show what happens. So this is only half of where we are today, because the low R less than G is an issue, but we have another issue, which is that because we have low inflation, the low R, the low real rate, also implies a low nominal rate. And so we are in a situation in which the low nominal rate, which we would like to have, is actually negative, and we can't do it, or we can't do it more than epsilon. And so you have a combination of two things. The first one is, you know, the secular stagnation, the fact that the neutral rate of interest, safe rate, is very low, less than G. And in addition, because we have low inflation, the nominal rate is higher than we would like it to be, right? So you have a combination. I make this point because these are two separate issues. They turn out to be, you know, both present, but they're conceptually completely different. You have R less than G, and you have I, the nominal rate, greater than I star, which is the nominal rate that you'd like to achieve if you were a central bank. And so you have the effective lower bound. Used to be called the zero lower bound, but it's now called the effective lower bound, because we know we can go a bit below zero, but not much, right? So what happens in this case is actually fascinating, which is, okay, so the central bank cannot achieve R star, it cannot achieve a rate which would sustain aggregate demand. And so what happens is that what on the previous slide was just a savings glut, a lot of savings looking for investment and leading to a low R. In that environment, if you cannot achieve a low R, you're constrained, then this becomes an aggregate demand shortfall, right? You can't get the rate low enough to push demand in order to maintain potential output. So in that situation, you have not only the problem we saw, or the landscape we saw in the previous slide, but you also have the fact that you're likely to have something like Keynesian unemployment. So in this case, it's actually interesting. You clearly need more public spending in order to achieve potential output. So you get this combination, which again is very different from the past, which is deficits are essential in the short run because central banks cannot do it. And that's a discussion that we're all familiar with. But at the same time, because R is less than G, that is sustainable. So deficits are good and you don't have to worry about that, right? Large benefits and basically no cost in terms of welfare. So the combination of this tells you you're in a world in which there is a very strong case for expansionary fiscal policy. You can run deficits. It's essential because the central banks cannot do it, cannot do what's needed, and you don't have to worry about that. Now, all this would be fine if R was going to be less than G forever. And so that's basically the crux of it, right? And this is, I think, the title that Nicola gave to the to this meeting. Now, what do we know and what is it that we don't know? So the first thing is we know that, and you've seen this graph if you've been looking at this at all, that the safe rate, the safe real rate, has basically trended down since 1980, 1985, roughly. And it's an amazing line. I mean, it's basically just down. It's not due to the financial crisis. The financial crisis did a little more of a dip. And it's not due to the COVID crisis, which also is a bit more of a dip. But you know, you leave these two out. It's a trend. Now, it has to be said that if you want to show the trend, it's very smart to start in 1985. Because 1985 is really an unusual peak. If you start in 1970, then you have the thing going up and then coming down. So there's a bit of cheating, but it is still true that for the last 35 years, the trend has been there. And so you can't dismiss it as something which will turn around. Now, in the past, R minus G has been negative fairly often. This is something that I documented in my EA lecture, but other people have done a much better job of that. But it clearly didn't last forever. We kind of went back and forth. And so the question now is, okay, so are we in this kind of normal cycle in which it comes and goes, or is it going to be for a long time? And here, markets are absolutely convinced. You know, the yield curve says you look 10 years out, you look 30 years out. For the US, despite the fact that actually things moved up a bit after the election of Joe Biden and Georgia, we're still at minus 1% for the real rate, 10 years out, right? So, you know, whatever assumption you make about growth, it's likely to be more than minus 1% over the next 10 years. You can do more. You can look at option prices. And there, I didn't do it. I've not done it for a few weeks, and therefore I didn't want to give you all numbers. But basically, the probability that the markets put on the nominal rate, for example, being more than 4% 10 years out is 1%. So the markets are putting their money where their mouth is, and options are costly if you're wrong. So markets are convinced. Economists, I think, should be less convinced because, and this is a sentence I've used before elsewhere, I think we've identified many suspects for the low R, but we've not convicted any with great, at least I don't think a jury would convict if we actually had a trial. So let's go into it because I think it's really central to the way we think about the future. So there's two factors behind the low R. The first one is just that there's a lot of savings. There's not a whole lot of investment, and therefore, you know, this is a savings glut, if you want to talk to call it this way. And the marginal product of capital is just very low, and the safe rate by implication is very low. That's the first type of explanation. The second is to say, no, the marginal product may be fine. It's not really a savings glut. Is that people want safety, and so they are willing for a given marginal product. They are willing to hold safe assets at a very large discount, right? So these are conceptually completely different explanations. Both are probably relevant, but they're conceptually different. On the savings gut, so I've made a list here, the list could be longer. So demographics, and I emphasize this because there's a recent book by Goodhart and Bradhan who argues that demographics explain what happened and implies that interest rates will increase a lot in the future. And so here it depends very much on what is behind this demographics line. If it's the baby boom, then indeed what happened is that, you know, there was a lot of them, a lot of us, we saved a lot and we're going to de-save, so that's going to be pressure on the interest rate. But the dominant factor in understanding what has happened to demographics is the steady increase in life expectancy. It's not the baby boom. Life expectancy keeps increasing. And to the extent that the retirement age does not increase in proportion to life expectancy, then you can sit down, but you'll have to conclude that this should increase saving, because basically people have to save more in order to have enough for a longer period of retirement. And that's likely to last. So whether demographics explains what happened and whether it's going to continue or not is not clear. And I think Goodhart is basically wrong. My sense is increased life expectancy is going to dominate, and that factor is going to lead to lower rates for a long time. Another explanation has been not based on individual saving, but country saving, and the notion that emerging markets were very worried about the future and they were doing precautionary saving in effect, but at the country level, running large current account surpluses, accumulating reserves. I think that's true. The question is, will it be undone? Not completely obvious. I think that what they learned from the COVID crisis is it's good to have reserves, and the more you have, the better. So I'm not sure that they are going to decumulate reserves very much. On the other side, if you look from savings to investment, there is this line that has been explored by Larry Summers, which is the declining relative price of capital, which is that for any volume of investment, the value of investment is smaller. And that's what matters from the point of view of that equation. But at the same time, the fact that the relative price has decreased means that the cost of capital has also decreased, and that should lead to more investment. So it's completely ambiguous, and I don't think that's a major factor. So I go through the list. If I want to argue that these factors are relevant, I have an easy time. If I want to argue that maybe they are not, I have a fairly easy time as well, and therefore I worry. On the demand for safe assets, the demand for safety. So there's one place where we know it's relevant, is regulation. And basically we've learned about liquidity crises as opposed to solvency crises. And so we've basically forced banks and other institutions to have much more in the form of liquid, which typically is safer assets. Is this enough to explain what has happened? Surely not since 1985. Right? This is very much post-financial crisis, and I don't think it's big enough. So the other way of doing it is to say, well, people are much more uncertain about the future than they used to be, and therefore they want to hold more safe assets. And I'm not sure. I mean, the world is always uncertain, and I'm not sure that it's more uncertain now than it was in the past. So I accept, these as potential explanations, but I'm not convinced. So what will happen, I don't know. I don't expect rates to increase very fast, but I wish I understood better what was going on. The last line on this is the effect of the increase in debt to GDP, right? In the models we have, this is going to put pressure on the rates. It's basically decreasing saving. And we have estimates, but again, that's a place where God knows what these estimates are worth. But we have estimates from various papers that if you increase the debt to GDP ratio by 1%, 1 percentage point, you have an increase in the safe rate of 2 to 4 basis points. If you take this as a given, debt has increased as a result of COVID, probably will have increased by 25% debt to GDP. That increases the safe rate by 100 basis points. It still doesn't change the sign of inequality. it goes in that direction, but it doesn't. So here I think we have to accept the fact that we don't know. But yeah, it's probably going to remain low for a long time, but there's a good standard deviation band around it. And so when you think about fiscal policy, I think that's a mode in which you should be. Okay. Let me see how much time I have spent. Nicolas, tell me, because then I'll decide what I cover and what I don't cover.
You have spent 23, 24 minutes.
I have spent that?
Yes.
Okay, so this maybe we come back to it in the discussion. I have 2 slides. I'll just mention the main points, which is, well, how do you basically assess debt sustainability? And it's clear that if R minus G was going to be negative forever, then there is no issue, right? That is sustainable. You don't have to worry. But clearly, the big issue is that R minus G is uncertain. And it could change sign and it could become an issue. And so the way it's basically, it becomes fundamentally a probabilistic statement that, what is the probability that you get in trouble, basically. And so put more succinctly in red here, I think a useful question in thinking about debt sustainability is, given the uncertainty about R minus G and other things, what is the probability that the country cannot generate a sufficient primary surplus to pay for debt service? So in expected value, it's going to be able to do it in the environment in which we are. But if you take into account the distribution, you have to say, suppose that you get to the 95% end of the distribution, will you be able to generate a primary surplus? And the rest of the slide, I discuss how this can be done. I'll mention this slide, which is that this is an environment, and it's sovereign debt markets are an environment in which you can have sudden stops or multiple equilibria. It could be that if investors think it's not risky, then the interest rate will be low and it will not be risky because debt will not increase very much. There is very often another equilibrium, which is that investors worry, think it's risky, ask for a risk premium. This leads to completely different debt dynamics, and in the rational expectations equilibrium leads indeed the worries of the investors to be justified. So what I've been working on is very much understanding this, and the issue is this can really happen, and there is a range of debt in which you have 2 equilibria. You have a good one, you have a bad one. But the point I want to make here, and again, we can come back to this, is that the range is very wide and starts at very low levels of debt. Like in my simulations, it starts say, at 40% debt to GDP. We are now at 100%, right? So there's no way we can hope in any finite time to get back to 40. It would be nice, but we're just too far away. So the question is, what can we do? What is the risk? And I will end with, I will not talk about the next slide, but I will end with the last point, which is, well, maybe the central bank can come in and just basically buy. If it thinks that investors are wrong, it can buy sovereign bonds and make sure the good equilibrium is ensured. It sounds like a good answer until you realize that the central bank actually is part of the government. And it doesn't change things much if it becomes debt by the central bank or debt by the government. Now, at the same time, we know it works. So we have to understand. But this is a very serious issue.
Did we lose Olivier or is it me?
I lost him too.
Yeah, I lost this too. I don't hear anything else. Yeah.
He was out of time, but I didn't cut him off, huh? Oh, now he's completely gone. Oh, here he is. Olivier, you're muted. You're muted, Olivier.
Yeah, the internet was just waited for me to finish until and then disconnected. So I'm done.
Very good. Thank you, Olivier. John, do you want to follow up?
Pleasure. Let me see if I can get my slides to work here. So I hope you're seeing my slides. Okay, good. Well, this is a great pleasure. Thank you so much for inviting me. Let me show you the right slide. There's the one I want to show you. So let's just jump right in. It turns out this is a great chance to discuss things. I always love discussing with Olivier because I learn a lot. I'll start with the question you wanted us to start with. Why are interest rates still low? And then I'll come back to sustainability. So I put up the plot that Olivier referred to. Here's the 10-year treasury rate and the CPI in the since 1960s, actually. And you can see this amazingly steady trend. And it starts in around, there's the year 1985 that Olivier referred to, and it just trends downwards. So that fact that it's so steady tells us a lot. It says that a lot of the things people talk about, which are recent or ephemeral or recent events, just can't be the central explanation. Foreign exchange reserves after the 1990s crises, central banks, quantitative easing, zero bound events, liquidity premiums, and so forth. You need to look for something big and structural. These effects are there. I think of them as icing on the cake, but they're not the actual cake. Now, it's important for us to understand this, and Olivier is exactly right. If you want to think about how long it's going to last, you need to have economics about why it's there. You just can't take trends as given. And it's interesting how little we actually know about this big event. So PhD students listening, take it from the two of us, there isn't a solid understanding of this fact. And if you ever want an illustration of why Hayek was right on how hard it is to understand prices, look at all of us trying to figure out this most basic of all prices that goes on for 20 years, and we're not that sure about it. But you got to start, I think, to looking at basic economics. Demographics is one of those kinds of issues. But what does basic economics say before we have fun with all the frictions and things that make for more interesting PhD theses? So as I start for Econ 1 basics, my starting point would be the neoclassical growth model. And I put that in equations. The interest rate is impatience plus the growth rate per capita. To do it right, you adjust for population growth or the marginal product of capital. That's where we start from. And let's look what's happened. I put down GDP, potential GDP growth here, because that's just an easier way of looking at long-run trends. But as you probably know, in the 1960s, it was around 4 or 4.5%. In the 1970s, a very important feature of the 1970s was the first big productivity slowdown to 3%-ish. A little boom in the late 1990s, and now we're down to under 2%. And the CBO is forecasting 1.6% for the rest of our lifetimes, this is the economic tragedy of our time. Nothing counts for economic well-being other than long-run growth. And we've cut that more than in half in our lifetimes. Why is this? Now, just to review the idea behind here, how would growth affect interest rates? The lower growth profile means that consumption's growing slower, and so interest rates are lower. And I think this relationship, let's just think of supply versus demand, which curve shifted. And if it were people got more patient, if the delta went down, then we would see the interest rate going down without the growth rate changing, or we'd see the growth rate going up while the interest rate doesn't change. That's not what we saw. we saw is R and G moving together. That suggests it's not something like a change in preferences, a change in demand, a change in demographics. It is, in fact, the G and the R moving together, the product of capital. Now that leads us to why is the marginal product of capital falling? And here we have a great discussion that's beyond today. The Larry Summers view, which lots of people have this view, we have less capital intensive technologies these days. I don't know, I look around, I see a lot of capital that needs fixing. The end of growth idea, I mean, really that's it. We're seeing the end of growth. Is that because we've run out of ideas? They promised us jet cars and all we got was Twitter. Or is it in the theta that more taxes, regulation, and protections are slowing down innovation? I'm a techno-optimist. That's what I hope it is, because that one is more easily fixed than the others. And, you know, when will those things change? That's sort of the Econ 101 basics. I think that's where we got to start. Unless demographics, that's been, you know, the lifespan's been going on since the 1900s. And there's lots of things that change people's savings rates. You know, now we also have government programs and Social Security and so forth that lead to less saving in midlife. So I don't know about that, but it's a discussion. It's an important one. We don't really know. Let's start with Econ 101 basics is my encouragement there. And that leads to, like Olivier said, a trend that's likely to go on for a while or may change when we get back to growth. Now, I don't think we can approach this question without asking what happened in 1980. Let me remind you of the graph. I went back to before 1980. Something dramatically changed there. And so if you look for things that have been going on for the last century, that's not going to be the answer. I should also warn, looking ahead a little bit, Olivier said, you know, markets don't see any sign of danger. I've got the 10-year treasury rate and inflation. Notice that interest rates never saw the spikes in inflation coming, and they certainly never saw inflation going down again. We politely call this time varying risk premiums in finance to say we don't know, but it is certainly the case, especially if Olivia and I agree entirely, this debt crisis mechanism is the thing to worry about. Markets never see that coming by definition, because if you saw it coming, you would have run today and it wouldn't happen. They didn't see the last ones coming either. But let me get back to the point. So we're trying to think about where did the interest rates come from. Our story has to say something about the end of inflation changed dynamics somewhere. I think there's a story here too. There's a second big, there's two equations that govern my life, the neoclassical growth model and finance. Average return equals risk-free rate plus beta times premium. In the 1970s, it's hard to see here, but I didn't want to make extra graphs. Bonds were a positive beta security. Inflation rose in recessions. You can see that right here. Bad news for bonds, and bond prices fell. So bonds were risky. Since then, and especially in the last two recessions, government bonds have become a negative beta security. There's the flight to quality in recessions. Inflation goes down in recessions. So both nominal bond prices rise and their real value rises. This is great stuff to hold in a financial crisis. So they have negative beta, and it doesn't take a lot of negative beta to drive down the risk-free rate. So that seems like a second Econ 101 thing to think about, much more ephemeral. We could go back to that much more quickly than we're going to go back to higher growth. And so that I think of as part of the mechanism where things could get unhinged later on. Now, here we have an even bigger puzzle. If we don't really know, that long run interest rates going down, why inflation expectations are anchored. That's clearly what's going on, but why? Our central bankers seem to think they're anchored because they give much better speeches that they gave in the past and much better promises about what they might do in some future event. Good luck with that. Now, there's a lot of fun going on with other things. I just brought two along. I think these are icing on the cake, but not the cake. So one, government bonds are special. There's a liquidity value to government bonds. They sort of have the money feature of paying lower interest rates. But here I've got the treasury rates, the AAA rates, and the mortgage rates. The Treasury are the liquid ones. AAA are kind of medium, and mortgage is completely illiquid. So the spread, there is a spread here. It's about a percentage point, but it's not accounting for the 4-5% decline, and it's not getting bigger over time. So that seems to me like icing on the cake, not part of the main story. It is something, though, that could go dramatically wrong. That's what Olivier started alluding to, and I'll end with, that the premium for government debt could go the other way. Is the dollar special? That would be nice to believe for those of us whose future taxes come in dollars. But you know, Euro and Japanese interest rates are lower than the US and have declined more than the US. So I don't see an argument in the rates here that it's particularly a specialness of the dollar. Our exorbitant privilege shows up more in quantities, I think, than in prices right now. And conversely, European and Japanese rates are lower than US rates. And sadly, European and Japanese growth is lower than US growth. So I think that the basics of the growth model are enforced there. Now, let me go on to the more interesting view. So where are we? We've got some stories. I think we're both highlighting how important it is to understand this and how we should start with Econ 101 and how there's a lot of room to do that. Because if you don't understand it, you don't know when it's going to blow up. But let's talk about the government finances issue. And I'm just going to repeat Olivier, maybe louder or pounding my fist on the table a little bit more. So here is in continuous time, the evolution of government debt. B is government debt, Y is GDP. And that's how government debt evolves. It grows at R minus G. And if you run primary surpluses, it declines. So what about R less than G? This is the new fascinating opportunity. And if you look at this equation, R less than G opens up a Pandora's box. Yes, just look at the equation. If R is less than G, the government can run primary deficits S less than 0 forever and keep the debt to GDP ratio constant. It kind of works like seniorage. A government that can print money can, you know, as long as the economy is growing, gets to buy stuff with free money. It works in somewhat the same way. Second tantalizing possibility, if that's a negative number, set S to 0, you can run up a big debt to GDP ratio, and then it'll just slowly decline all on its own. You can grow the debt to GDP ratio. Now, watch out for that latter one. This is not modern monetary theory. To get that to work, the low R opportunity must be scalable. As you raise debt, if that raises R, you run into that this eventually runs out. And that's exactly what Olivier is saying. And we all know at some point you run into there. I don't know where it is. Olivier doesn't know where it is, but this is, you can't do this at arbitrary scale. Second, this is an argument for 0 primary surpluses, not endless deficits. You still have to pay. There's a lot of feeling, oh, debt's free, so why should any of us ever pay taxes again? Why do we have to work? No, you need S of 0, which means taxes equal spending. So this is not we never pay taxes again. We pay the taxes to finance future government spending. So what about this? I'm going to embarrass Olivier a little bit. This is brilliant. And if you have not read Olivier's AEA address, you need to go read that this afternoon. Given at the moment he gave it, as we are heading into big fiscal expansion, this is as important for our generation as Milton Friedman's address was in 1968. It even has the seeds of how it could go all wrong. So Olivier's bases are covered. If, as I think, it's all going to go all wrong, that's in his address as well. And the R greater or less than G is just really hard technically and worthy of study. But, so here's my critical, not of Olivier, but critical view of it. I think this is irrelevant to the current US and EU fiscal situation and the policy questions we're facing. Why do I say that? Let's think about the first option. Can we run steady deficits, steady primary deficits forever? Well, yeah. If R less than G is, let's say, 1%, then you can run and debt to GDP rate, then you can add a debt to GDP ratio of 100%, and S to Y can be 1%. You can run a 1% of GDP deficit forever. Well, here's the CBO deficits. We've been running 5% deficits, 10% in every 10 years. It looks like we get a once in a century crisis. We're going to hit 20 or 25% by the time COVID is over. The chance to live on 1% debt to deficits forever is just irrelevant to the issue of 5%, 10%, and then the future is the real problem. The unpaid, the unfunded mandates, which are 5, 10%, and over. The U.S. fiscal issue is European entitlements with American taxes, and we got to make up our minds which one of those we want. Let's look at the second related opportunity. How about this one-time fiscal expansion? Well, I wrote down a quote from Olivier when he was talking. Suppose you start from a stable debt to GDP ratio, then you can do a one-time fiscal expansion and grow out of it. Well, we're not starting from a stable debt to GDP ratio. Here's our debt to GDP ratio. This is the CBO forecasts. And the CBO, these are forecasts before the one-time fiscal expansion and before the next inevitable crisis. I kind of drew a trend. Here's the Great Recession. There's the pandemic. Something bad's going to happen in 10 years. So that's really what I think our path is. R less than G does not justify endlessly growing debt to GDP ratios. It's a one-time, and then you have zero primary surpluses. That's just not our situation. Furthermore, so we all go to an economics conference, and the R greater or less than G point becomes, wow, just one side or the other side of an identity, and either you live in the land of manna from heaven, or you live in the land of the bond vigilantes are coming. Now that doesn't make any sense, right? 1 basis point above and 1 basis point below can't possibly make this huge difference, right? Right. And let's see why. The reason is this opportunity, a one-time fiscal expansion and then grow out of it, can take a very, very long time. So I drew down here, suppose we expand debt to GDP to 200% of GDP, most of the way to Japan. What happens at R less than G of 1 percentage point? Well, 10 years, 25 years, 50 years, 100 years. It takes 138 years although we're back into what Olivier sort of said is safety land of 50% debt to GDP ratio. If we have a 1 basis point, R less than G, then it's, 10,000 years before we're at it. So that at small R's less or greater than GDP, just make this strategy of one-time expansion and roll it off. That just takes forever. And so you can see now how this whole business is continuous. Now, you want to bring down debt faster than 138 years or 10,000 years. What do you got to do? You got to run surpluses. So as a practical matter, R greater or less than G by even a couple of percentage points is still going to mean if we do a big fiscal expansion, we're probably going to have to run some surpluses to bring it down at any rate. Or at least this is a continuous question. It's a quantitative question. It's not a sign question. So that leads me to, by the way, Olivier spoke right about here. We've spent $5 trillion already on a big fiscal expansion. A lot of the welfare effects are going to depend on what we spend it on, which is not what we're talking about today. The US has spent it, I think rightly, on transfers. We write people checks. You got to help people out in recession. Some of those transfers were helpful. A lot of them, like checks to registered voters, who was just a waste. And clearly the planned, we're now heading into a planned fiscal expansion. That you read what the Biden administration wants to do, and they're going to do a big fiscal expansion. Most of that will also be transfers. Now the welfare of this effects have to depend on what you spend it on. Is it, for example, if you spend it on things that raise G, that's wonderful. If you just spend it on a blowout of transfers, writing checks to people, at least that part seems to be more questionable. But that's not what we're here to talk about today. So let me conclude. How does this end? Really, that's our how and when does R change? That's why we started thinking about the economics of R and how robust are those. And is this good or bad when are inevitably changes? I started with G and R moving together because of supply side growth going down. I would love it if we get to growth. Warning, if that was right, the growth rate going back will come with higher interest rates. And that's it's an interesting paradox, a classic Finance 101 paradox, that a greater growth rate means a greater discount rate and can actually lower present values. So this actually would cause higher R with higher G. The R moves faster than the G, gamma is greater than 1. So it actually would cause you to move out of the sustainability region, or it causes fiscal problems. But I think those fiscal problems are easy to manage. If we move back to 4% growth, we'll be fine, no matter what R minus G says. I pointed to the inflation negative beta channel. That happens fast. That happens when people lose faith in expectations. And you lose a couple of percentage points of R very quickly. And it happens in bad economic times like the 1970s. So that, I think, is an element of the doom loop, which is what Olivier pointed it out. And I think that is the danger we face. And just to make it salient, how does this work? Well, what happened to Greece can happen to us, even though we print our own money. Suppose there's a 200% debt to GDP ratio. We've done the one-time fiscal expansion, but we haven't cured our long-run spending promises, and markets start to worry. So the interest rate rises to 5%, the interest rate on government bonds, a credit spread. Well, a 5% interest rate now means 10% of GDP more debt service, which means a 10% GDP more deficit, which means we got to borrow another 10% of GDP on top of the 20% we're already borrowing to fight whatever the crisis is. And markets say, oh boy, now I'm worried even more. Right? Interest rates go up to 10%. And you can see how that can become unstable. It either becomes a default, a restructuring, or a sharp inflation if the Fed chooses to try to buy up all the bonds and not pay interest on it. Now we say, the US prints its own currency, so that'll never happen. Don't bet on it. Default can happen, and it can happen to countries who issue their own currency. And I'm trying to make this salient, which is why I want to tell these stories. So, suppose in 10 years there's another pandemic, a war, a crisis. Surely something bad is going to happen in our lifetimes. The US needs another $5 trillion to bail out and send money. 20% of GDP or more. Each one seems to be bigger than the last. We need a 10 trillion to roll over the debt coming due that year. And so we're into this rollover borrowing trouble. Now, let's suppose there's continued political chaos. Unless you're not following the news in Europe, political chaos in the US is just getting worse. And our government is trying to address this crisis. So here's your choice. Are you going to pay China, pay the rich, pay Wall Street on government debt ahead of needy Americans who need checks? Not obvious to me that Congress is going to make that choice. So what are they going to do? Well, they're not going to just default. What they're going to do, Olivier is the world's expert on debt restructurings. We were talking about that just as you start. You give a haircut. There is a rescheduling. You do what governments have done for 1,000 years. You take your short-term debt that's coming due and you force a conversion to low-rate long-term debt. That would be a financial and economic catastrophe. Why? Because US debt is at the core of our financial system. The whole idea that government debt is completely nominally risk-free is what makes it money-like. So you get the world's biggest run on sovereign debt. You get the default and the inflation. And I'm grumpy, but even I am not able to really visualize the catastrophe that follows after that. Now, what can we do about this? I got to put in a plug. Long-term financing would help immensely. And Olivier didn't talk about this, and I'd love to hear his views. If we do the one-time fiscal expansion, which has to end at some point, guys, then at least if we did it by issuing perpetuities, long-term debt that does not need to be rolled over, that would cut off this doom loop entirely, and we'd be back to regular old public finance. So that is the number one thing we can do. Number two thing we could do is spend as if we have to pay it back. we do have to pay it back. If you want to bring back the debt to GDP ratio in finite time, yes, man. And I didn't put this down as a point because it occurred to me while talking. So Olivier said, and quite rightly, there is no magic debt to GDP ratio where you're safe on one side, not safe on the other side. Why not? It's not just multiple equilibria. It depends on bond investors, on their beliefs in your ability and your fiscal stability in the future. At the end of World War II, the US could borrow 141% of GDP. Why? The war was over. We were going to a situation of primary surpluses. We were going into strong supply side growth, and there was a lot of financial repression. Even so, there was some inflation in the late 40s and some in the 1970s. What makes the current situation dangerous is not just the debt to GDP ratio, which, as Olivier points out, is you're not going to get down to 50% in a couple of years. What makes it dangerous is that the plans for the future are so bad. We're in supply side stagnation. We have out of control future expenditure patterns, and we have political chaos ahead. When bond investors are thinking about starting the doom loop, they're looking at the future, not just the debt to GDP ratio. So, last thought, why is R low? That's the question we were asked to think about, and what does that mean? Great question. You've seen both me and Olivier struggle with it and summarize what we've seen out there. We need economics of it. And I would just say too much commentary looks at this trend and says, well, look at that trend, it's going to go on. Beware trends without solid economic foundations or without thinking, as I have here, about how that trend could end. I'll remind you of the most famous economist of the 1920s, Irving Fisher, who said stocks at our permanently higher plateau in the summer of 1929. Let's not be Irving Fisher. Thank you. I'm done. So Alberto, who's in charge here?
But if I can ask a question, no, and take advantage of the silence now.
Sorry, let's just start first with a few comments, and then we'll open the floor for questions. David, sorry. Well, thank you both for this very nice, interesting intervention. Let me say that I have a bit of mixed feelings here, split heart with respect to Olivier's presentation. On the one hand, as he said, you cannot discuss the arithmetic, and I've worked a lot on these R minus G models in the context of rational bubbles. So, you know, I think the math is flawless. On the other hand, I'm also from Argentina, and so I get worried whenever a prominent economist like Olivier seems to give theoretical foundations for politicians to spend. But I know where he's coming from. But basically, I wanted to summarize the argument. I think there's basic agreement between the both of you. I have the slides in advance. And let me just make two remarks, and then I'll open the floor more than questions. So it seems that the two key points here in the debate are, number one, as John was saying, to understand where this low R is coming from. And specifically the R minus G, because Olivier, you and I were both there last year at the IMF annual conference. There was a paper presented by Paolo Mauro and co-authors, where they show that in fact R minus G has been a little bit the norm for many countries in the 20th century. And yet
R minus G negative.
R minus G negative, that's right, yes. And nonetheless, it's come to an end. So I think we need to understand where, you know, it's coming from for two reasons. Number one, because it could be overturned. But number two, also for the implications of spending is important. You were just mentioning that if R really reflects a low marginal product of capital, we're in a dynamically inefficient world, and there the debt can even be good because you crowd out, as you pointed out, inefficient capital. The other possibility is that R is depressed because of some frictions. Could be taxation, John alluded to that very quickly. But another argument, for instance, that Fari and Guriot have put forth is market power, and that opens a wedge. So we could live in a world where R is low, but the marginal product of capital is high, and here the welfare implications of all of these are very different. And there is some empirical evidence, in fact, that suggests that the marginal product of capital has not been falling alongside the risk-free rate. So I would like to know both your opinions on this. So one point is, where is this coming from, and is the world we live in, will this world last? But the second point, which was also central, once again, John alluded to this, Olivier, you were cut short in your presentation, so I would also like to hear your thoughts on that. Is that, of course, even if R minus G is not reversed, we can have rollover crisis and all types of problems. So, for instance, for emerging markets, this is a very big deal. And in fact, it was in the 80s. You could argue that R minus G for them, when liquidity was abundant in the 70s, was negative, but eventually that led to the 80s sovereign debt crisis. And even countries that issue in their own currency, let's think of the euro area, which is special. Let's not talk about the US. John can comment on that if he wants. The debt situation is very heterogeneous across countries. So you have countries like Italy that will come out of this COVID crisis with about 160% of debt to GDP, Spain 130%, but other countries with much lower debt. Now, you put the ECB, by the way, I want to make clear that I'm not affiliated to the ECB anymore, despite what the flyer said. So what I'm going to say is strictly personal opinion. But the ECB can find itself in a very difficult position if you have to go out and keep spreads low of these countries, because very slight increases in spreads can make a big dent on the fiscal situation at these debt levels. You can see how there can be infighting and split across euro area members. This can put a lot of political strain on the system. And this is all without mentioning other implications of the low interest rate world that none of you alluded to, but other people have pointed out. For instance, there's a lot of risk-taking going on in big parts of the financial system with these low rates, apparently. There was just an article a few days ago on the FT, how many financial intermediaries are just borrowing like crazy and using these to buy assets and, with prices going up of these assets and putting themselves in very risky situations. Low rates also apparently are keeping inefficient companies alive, that as soon as interest rates go up, might go under and carry banks under, for all we know. And on top of that, we now have the COVID crisis. So on top of this debt that is right now explicit public debt, we have all these contingent liabilities that may arise, I think with a very high likelihood in the near future. So of course, this puts a lot more strain. I would like to know your opinion and also John's on this additional. And one last comment, let me say one last thing. One thing that I found very interesting is that none of you mentioned monetary policy at all in low rates, except perhaps for John's point on the anchoring of inflation expectations. This is very interesting because central banks seem to be doing a lot of soul searching about this low interest rate world and how their low interest rates that they're imposing have side effects and so on and so forth. But you have both focused more on the real part of the story. So I would like to hear your view about, are central banks just a sideshow on all of this, or are they playing a role? Thank you.
Who do you want to go first?
I'm happy to. I hope there's time left for you, John, at the end, because given the number of questions. So let me go in reverse order. And I am of the school which thinks that monetary policy reflects fundamentals, that basically there is a neutral R out there, R star, and that monetary policy tries to basically achieve that R star. So I'm not, I don't give much causal role in the determination of R to monetary policy. I think the issue is that they cannot at this stage achieve R star, they're stuck. But that's what they do. So when I hear central banks are responsible for low rates, that seems to me just plain wrong. On the risk taking, yes, I mean, there are many other aspects of low interest rates. And one is indeed maybe excess risk taking. That raises the issue of whether we don't want to change R star. And in effect, we can change R star by using fiscal policy, for example. I mean, larger deficits would lead to a higher R star, and maybe this would be good. Maybe this would decrease risks in the private sector. R star is the neutral rate, but it's not independent of fiscal policy. So it may make sense. But that's, I mean, that dimension is very relevant. On the rollover crisis, I really think the emphasis on countries which have their own currency or issue debt in their own currency is overplayed. And basically what they can do is that they can default through inflation. Okay, that's it. The other guys have to default the old-fashioned way. I don't think you get much more than that. On the fact that...
Let me ask you just one question. Do you see any specific concerns regarding the euro area where there may be more of a political divide, let's say, in the decision to intervene in some of the debt markets?
So again, I don't know what you have in mind. If you have in mind kind of fiscal dominance and the ECB, yes. The nice thing about the ECB is that it has 19 masters. And so in the US, when Trump was president, remember that? It was, a while back. He could probably take his phone and tell Powell or whoever he had put in place at the Fed and say, you keep the interest rate low, otherwise, God knows what happens. The nice thing about the Eurozone is that it is very unlikely to have 19 people on the phone agreeing about anything as to the message that they would send to Madame Lagarde. So I don't think fiscal dominance and the use of inflation is actually in the cards. That's a short answer. We could expand, but no. On whether the low R means dynamic inefficiency, no. I mean, it may well come from various distortions, although some of them will lead to dynamic inefficiency. I mean, suppose, for example, that most of the interesting investment opportunities in the world are now in emerging markets, not an implausible assumption. And think of property rights as being very mediocre in those countries. Then the rate of return that you want to have, or given the risk, will be very high, and that might lead to very low safe rates. So there are some distortions which are going to lead to very low investment with the amount of saving that there is going to lead to low R, and that's going to be like dynamic inefficiency, except it should be repaired not by issuing debt, but by improving property rights. So it really depends what distortion is at play. On the maturity, just 1 point, 2 points. The first one is, this has been discussed by others, which is you have a tug of war between the central banks and the treasuries, which is the treasuries want to increase maturity, and what QE does is basically buying long-term securities, and to first approximation, it cancels. It would be nice to know what the right solution is. There should be one or the other, and what makes. And it's clear that this is done without much coordination, and that's a serious issue. The other is that increasing maturity for the state, decreasing the rollover rate, the rollover risk. That's clear. You're not confronted to it all the time, but it also shifts some of the risk, which is decreased. I mean, the state now knows at what rate it's going to borrow for the next 10 years, say. But the private sector might actually be, as a result, be taking more risk because maybe it has lenders to itself which want short, and now it basically has to lend long. So it shifts risks from the public sector to the private sector, and I'm not sure that's always a good idea. I mean, from the point of view of the public sector, in a narrow, selfish way, it is. But from the point of view of what's good for the economy, I'd look twice as to whether increasing maturity, which is, I think, what John said, is obviously a good thing. I could go on forever. Let me see.
Olivier, basically, your argument is that if there's demand for these short-term things, someone will provide them, and if the government doesn't do it, the private sector may produce too much of it.
Yeah, and then it's going to have mismatch maturities, right? So I think there is an issue there. I mean, the risk is somewhere. You can eliminate the rollover risk, which is a different beast, but the matching issue, if people want to lend short and the borrowers want to borrow long, somebody has to be in between. Now, the government can avoid being in between by issuing long, but then the private sector will have to do it. It's just, when you sit down with all the equations, you see that it's a bit more complex. Right? Fiscal policy, I want to take 2 points that John raised. I mean, we have to disagree about something because, you know, for people who were hoping that we would just be fighting on Zoom, it must be extremely disappointing. Fiscal policy, no, we agree actually on the course of fiscal policy in the US. I mean, before the COVID, fiscal policy was not right. Didn't make any sense to have these increasing deficits as far as the eye sees. COVID is completely justified. I think the spending for COVID is completely justified. The interesting issue is after. Suppose we come out of COVID and private demand is still weak. So we're still in kind of a secular stagnation world. Will we be willing to run deficits? And if so, for how long? That's a serious issue because that is going to increase, going to have an effect on the interest rate and so on. And if it looks like we have to run large deficits for a long time, I think we should be much more open to finding other ways of increasing demand, which are not deficit spending. And I put one on the slides. I didn't have time to do it, but to talk about it. But if we think there's too much saving in the US economy, I know one reason. It's the health system, which basically leads people to do enormous precautionary saving. So I'm sure that John will fully endorse my proposal for Medicare for all, which would decrease precautionary saving and lead to higher aggregate demand. That would be very nice. And then the last thing will be something that John and I have interacted on by email in the last 24 hours. The Euler equation is an intellectual crime when it's used to describe aggregate consumption. It is perfectly reasonable to think that it applies to individuals, but in a world in which individuals die, then it makes no sense and has no implication for the relation between R and G at the aggregate level. So I would take away the course that econ 101 that John is teaching, or at least I would ask him to remove that equation. It was provocation, just to make it fun.
So
you want to reply? Start with what you disagree the most with Olivier.
well,
Fight.
and let me try to tick off as quickly as possible all the answers to the many great questions you asked. A little bit of disagreement. I did not address the question of whether debt by itself is good. This came up in your question about dynamic inefficiency, and let's start with that. So the dynamic inefficiency idea, there's ideas that are infinite period where that's kind of a parable, and there's ideas that the infinity really matters. And the dynamic inefficiency one is where the infinity really matters. So let me just break the bad news to you. 4 billion years from now, the sun will explode and engulf the earth. We're done. R less than G cannot last forever. Similarly, we disagree a little bit on this interest rate zero secular stagnation. Before COVID, the unemployment rate hit, I forget what the number is, 3.5%. Japan's unemployment rate been 3% forever. I just don't see the signs of deficient demand going on for decades here. I see stagnation in the supply side, which is where our growth theorists see stagnation. So if you want a little bit of a difference, sort of the value of just having government debt out there and how that has good, there's a bunch of frictions, dynamic inefficiency or secular stagnation. We could disagree about that a little bit. Let me put another way that on the dynamic inefficiency. Any theory that says the present value of government surplus is infinite, and this is a pure money machine that we can live off of, there's something going to be wrong with that. Now, there's a technically very interesting literature that I don't want to delve into, but there's a difference between discounting at the rate of return of government debt and proper discounting. Henning Bohn's written about this. The fact that the marginal product of capital is above the growth rate, I think, puts us there. The present value of government surpluses is finite when you do proper stochastically discounted, although the rate of return can be less than G. And that unwinds some of the magic of these things. Contingent liabilities are extremely important, and that's actually what keeps us up at night. What I described of every 10 years there's a crisis when we want to stimulate. And Olivier is right. Much of the spending was useful. Much of it was wasted. Checks, writing checks to every single taxpayer is a waste. If you think government debt is, writing checks to people who have lost their jobs, good. Writing checks to government employees on a retirement, everybody would like checks, but that doesn't help.
I shall interrupt you here with an anecdote. Some of you may be following me on Twitter. 2 days ago, I said, think twice about sending $2,000 checks. Why don't you send it to people who actually need it?
Yeah.
The reaction was, I got 2 million impressions, 25,000 replies, all insulting.
Well, if money's free, why should we pay off any of our debts?
Right.
That's and the recent stimulus bill is so larded down with pork to political constituencies. It's hard to say that's useful spending. But no, that's part of Let me close. That's one of the contingent liabilities, and you're exactly right. The U.S. government is on the hook for everybody's mortgage. They're all explicitly credit guarantees, and we're going to bail out. We're going to bail out the financial system in any trouble. So the contingent liabilities are a big part of, if you want to think about how does things go under. You're right. You asked about monetary policy, right? Money's neutral at the decades horizons we're talking about. However, I'm this fiscal theory of the price level nut. I actually think they have more power. If they, every theory and the data that I see says that if you announce ahead of time and slowly and steadily raise interest rates, you can in fact raise inflation. So they can affect nominal things even now. And so they are a little more powerful even than Olivier says. That brings me to the euro. I do think the fiscal theory of the price level describes Europe. And I think Europe is in danger of fiscal inflation. Because when the time comes, it doesn't matter what the heck they try to do with interest rates. Europe has a monetary union, a currency union without fiscal union, and 26 hands on the printing press. And now the ECB is buying sovereign bonds and green bonds. You're going to go into big green bonds. And when all that blows up. Now, a currency union without fiscal union is fine. You just have to agree that sovereigns default like corporations. A currency union with fiscal union is fine, and then you have to agree, who's in charge here. But you're kind of in the worst of the fiscal dominance case that lots of people get to issue the debt, which the ECB then buys up, and choose which it's going to be. I would prefer that you have a beautiful system here. You just got to agree that sovereigns are like corporations and they default, or you have to move from your Articles of Confederation to a constitution. And have central government debt and working like the U.S.
Shall we take some questions, John, or is there?
Let me just close with. You asked so many important ones that I wanted to. I'll skip that one. Just the last one. In the grand scheme of history, as an Argentinian, ever since the Peruzzi defaulted, Edward III defaulted on the Peruzzi in 1350. Sovereign debt has been risky debt. And it's just amazing that we're now thinking of sovereign debt as being the safest possible thing. I think if we open our eyes, the dangers of this big fiscal expansion going wrong are something we should keep in mind. Okay, I'll stop there. Won't check off the rest of your questions.
Okay, thank you both. I think we're out of time. Sorry, because some other people had sent me questions, but unfortunately I got cut off. I think it was a very interesting debate. My simple takeaway is that low rates open up opportunity for fiscal policy, but we need to be careful. Anyway, let me pass the ball to Nicola if he wants to close the event or make some closing remarks.
Nothing specific, just want to say thank again to John, Olivier, and to you, Alberto, for participating to this very interesting event. So thank you on behalf also of all the IGIER, the Bocconi community.
Thanks for having us.
Thank you all. Bye-bye.
Thank you.
That's great.
Thank you.